Welcome back to the deep dive. Today, we're taking a look into a really fascinating, maybe unexpected part of finance. We're talking about Bitcoin treasury companies. And these aren't, just companies that happen to own some Bitcoin. No, these are potentially reshaping the whole global financial scene. Our mission really is to figure out how they're using corporate structures, financial tools to buy and hold Bitcoin on a scale individuals just can't manage, and creating new kinds of value doing it.
Yeah, and it's crucial to get a sense of the scale here. The traditional capital markets are just, well, immense. Think about it, $100 trillion in equities globally, maybe to even $300 trillion in credit markets.
Yep.
So what we want to explore today is how these Bitcoin treasury companies are uniquely set up to tap into, maybe even transform these massive pools of money. Consider this your fast track to understanding a really profound shift that's happening right now.
Okay, so let's unpack this a bit. Why are companies, corporations so much better at adopting Bitcoin than just, regular people? It feels a little backward at first.
It does, but it's actually a really powerful idea when you see the mechanics. Let's take an analogy, maybe a dentist, an individual dentist, right?
Mm-hmm.
Over, say, 20 years, maybe they managed to save up and buy, $4 million of Bitcoin from their earnings, slowly.
Mm-hmm.
But the second that dentist incorporates, becomes a business, suddenly they can tap into corporate finance. They could sell $1 million of stock, maybe in a single month, and immediately buy $1 million of Bitcoin. And they could potentially do that again the next month. It's just faster, more scalable.
Right.
An individual can't really compete with that mechanism.
Right. That really highlights this super spreader idea for Bitcoin adoption through companies. It kind of feels like, the war for the future of money is going to be fought with money. And corporate capital, well, that's a huge strategic weapon individuals don't have.
Exactly. And we've seen some, frankly, incredible growth stories because of this. Look at a company like Metaplanet. They started as, I think, a hotel business, maybe buying $1 million of Bitcoin a year. Then suddenly, they're issuing $1 billion in equity in 1 year just to buy Bitcoin. The speed at which a company can issue equity or credit, it can just explode exponentially. Individuals can't keep pace.
So if the way they get the Bitcoin is so different, how does that change how we should even value these companies? Because, traditionally, valuing a business is about future profits, future cash flows, right?
Yeah, that's a really key difference. You've nailed it. Traditional companies, their value is tied to future fiat cash flows.
Yeah.
Nigerian naira, Brazilian real, US dollars, whatever. And those flows are always vulnerable, right? Inflation, currency devaluation, competitors eating into your market share. Bitcoin treasury companies, though, their value is based on a stack of Bitcoin, something much more transparent. It's tied to this homogeneous asset. It's not really competing in the same way. It just changes the whole valuation game.
Okay, that sounds, well, almost elegantly simple when you put it like that. But surely, like any big financial shift, it's not completely smooth sailing everywhere. I bet there are obstacles, friction points.
Oh, absolutely. You can't just roll this out globally without hitting some bumps. You run into legal hurdles, regulatory issues, these friction points. They require local know-how. Setting this up in Japan is different from France, which is different from the UK. You need that specific expertise. And that's really where Michael Saylor's whole approach of building the bridge was so important. Before him, it felt, pretty risky for a company to just dive into Bitcoin, a leap of faith. But he didn't just talk about it. He built the model, showed how it worked, step by step. That legitimized it, gave other companies a clear path. That clarity was quite revolutionary, actually.
Whenever you hear about these new financial models, there's always that bit of skepticism. Is this real? Is it just hype? Maybe even some magical thinking.
And that leads to a really important question. Why should one of these Bitcoin treasury companies trade at a premium? Why not just buy the Bitcoin yourself? Let's go back to that dentist. Why would an investor pay a premium for shares in the dentist's incorporated practice? It's not just because the dentist is good at drilling teeth. It's because the business, the corporation, can get better loans, bigger loans, more scalable financing than the dentist could as an individual. Similarly, a public Bitcoin treasury company uses capital market tools individuals can't access. That justifies a premium.
Okay, so if the main goal, the ultimate aim, is boosting Bitcoin per share, how do we track that? How do investors know if management is actually delivering? What's the key number?
Right. The North Star metric, the thing they're laser focused on, has to be consistently increasing the amount of Bitcoin per share. That's the bottom line for shareholders. And the way we measure that is often using the market capitalization to net asset value ratio. We call it MNAV. It's simple. Market cap divided by the value of the Bitcoin they hold. Now, obviously, a common worry for investors is, Am I paying too much? Is the MNAV too high?
But there's a mechanism these companies use to constantly address that M&AV risk, isn't there? How does that work?
Exactly. They mitigate it by doing one thing relentlessly, buying more Bitcoin.
Hmm.
This continuous buying, this accumulation, it effectively pays down that premium over time. They're always working to boost the Bitcoin per share denominator, and that absorbs the premium you paid initially.
And didn't Adam Back introduce a metric that really crystallizes this idea? It makes it very clear.
He did, yeah. A very insightful metric called months to cover. It basically calculates how quickly the company's Bitcoin buying pays for the premium embedded in its MNAV. Think about Metaplanet again. At one point, their MNAV apparently hit 10. Huge premium. Then the market tanked, and it crashed to maybe 2.5. But because they kept aggressively buying Bitcoin, they covered that initial premium in just 5 months, and the MNAV recovered back up to around 7. It shows how forgiving this model can be compared to traditional stocks. Usually a crash means years of slow recovery. Here, active buying can pay for those dips much faster. It creates this resilience.
That really does highlight how crucial management execution is. It's not just the idea, it's making it happen. What else makes the successful ones stand out, strategically or financially?
It really comes down to how scalable and repeatable their strategy is. Can they keep doing it effectively? Look at Strategy, formerly MicroStrategy. They keep their debt pretty low, relatively speaking, around 15%, I believe. That gives them a solid financial footing for their ongoing accumulation plan.
And you touched on innovative debt earlier. Are there new kinds of structures emerging? I heard something about a unique convertible note.
Yes, definitely. We're seeing things like the Bitcoin basis convertible note. The blockchain group has used this. What's really different here is if the stock price doesn't hit the conversion target, the company doesn't just owe cash. They can actually return the underlying Bitcoin held by an independent custodian. It almost has a money-back guarantee feel to it, which dramatically cuts the downside risk, the tail risk, for the company itself. It's quite clever financial engineering.
Okay, this is where it gets really interesting for me. If a company's whole focus is Bitcoin, standard US dollar accounting must feel completely inadequate, right? GAAP accounting is built for operational earnings, not stacking sats.
You're absolutely spot on. Traditional accounting just doesn't capture the reality, which is why Michael Saylor effectively pioneered new metrics denominated in Bitcoin. First, you have BTC yield. That's the percentage increase in Bitcoin per share. So, for example, if a company achieves a 20% BTC yield, you might argue that justifies a 200% premium to NAV if you apply, say, a 10x multiple to that yield. Then there's BTC gain. Sometimes it's called BTC dollar gain. This is like the earnings number for a Bitcoin company. If they take $100 million in operating cash flow and buy Bitcoin with it, that's 100 billion BTC dollar gain, no dilution to shareholders.
So these aren't just theoretical ideas, they're practical tools for investors, to see what's actually happening.
Precisely. They give investors a really simple, transparent, almost instant way to see if management's deals selling stock, issuing debt, are actually adding value, accretive, or destroying it, dilutive, in Bitcoin terms. It makes the whole Bitcoin strategy transparent, which is often not the case with traditional corporate finance.
And how do companies actually generate this BTC yield and BTC gain? What are the main levers they pull?
Well, there are basically 3 main ways. 1, just sweep the cash flow from operations directly into buying Bitcoin. Simple enough. 2, sell equity, but sell it when your stock is trading at a premium to the net asset value. Like if you sell $100 million of stock when your MNAV is 2, you've essentially created $50 million in BTC dollar gain right there. And 3, issue credit instruments. This becomes especially attractive when the company's MNAV is low, maybe even trading at a discount to its Bitcoin holdings.
The credit instruments again. Is this what Saylor means when he calls it the killer application for these companies?
Exactly. This is where the BTC credit model really aims to revolutionize things. Issuing credit, like bonds or preferred stock, it's heavily backed, heavily collateralized by Bitcoin. The risk isn't based on fuzzy future earnings. It's calculated based on Bitcoin's volatility and what we call the BTC rating. That rating is just the level of over-collateralization. Imagine backing a $100 million bond with $1 billion of Bitcoin. That's a 10x BTC rating. You can then statistically model the risk, almost like using Black-Scholes for options, plugging in volatility and the BTC rating to figure out a fair credit spread.
And Strategy has actually created some of these instruments in the real world. Can you give us some examples of what they've done successfully?
Oh yeah, they've been quite innovative. 2 stand out. There's Strike. It's a type of convertible preferred stock. It gives investors about 40% of the upside in the common stock, plus an 8% dividend paid at its issue price. Par. The whole thing is engineered to give you roughly 80 to 100% of Bitcoin's price performance, but with maybe only 10% of the downside risk, plus that guaranteed dividend. It's explicitly designed to go head-to-head with Bitcoin spot ETFs like IBIT, arguing it offers a better risk-adjusted return. Then there's Strife. This is a senior preferred stock. It offers a 10% dividend at par. Crucially, the dividends are cumulative, meaning if they miss one, they have to make it up later, and it has senior preference over common stock. It functions almost like a perpetual bond, constantly paying that high dividend.
And who's the target audience for these kinds of, well, complex-sounding instruments? Who benefits the most?
Well, the target market is potentially enormous. Think about the huge pool of investors out there, maybe retirees, for example, who are looking for low-risk income. They want high yield in US dollars or euros or yen, maybe 8%, 9%, 10%. Now, they might not understand Bitcoin deeply or even care about it directly, but they definitely understand and appreciate an asset that's backed 5 times or even 10 times over by collateral, especially collateral that has tended to appreciate rapidly. It's basically building a bridge for traditional fixed income capital to flow towards Bitcoin-backed assets.
So pulling this together, what's the big picture here? This sounds incredibly ambitious.
It is ambitious. The underlying vision is pretty radical. It's about potentially replacing maybe thousands of existing, often illiquid old-style preferred stocks from the 20th century, with maybe just one or a few massive, highly liquid preferred stocks, maybe a $50 billion issue, trading $2 billion every single day, offering better yields, and backed transparently by Bitcoin. It's aiming for a complete digital transformation of the credit markets.
It almost sounds like financial alchemy, doesn't it? Taking these old structures and making something new and potentially much better.
Well, it's attracting capital away from what you might call crippled traditional instruments. Instruments struggling to offer yield without huge risk, and moving it towards these superior 21st century digital credit products. Think about it for a retiree. Maybe an order of magnitude less risk for potentially 200 basis points more yield.
Okay.
That is a very compelling proposition.
Okay, so a natural question arises. If this strategy is so good, won't everyone jump in? Won't more companies doing this just dilute the opportunity, compress the premiums?
That's a common concern. But the scale of the potential market is just so vast. Remember those numbers. Hundreds of trillions in traditional markets. If Bitcoin eventually reaches, say, a $200 trillion market cap itself, the opportunity is enormous. More players probably won't compress the opportunity overall. Instead, more participants likely lead to more liquidity, better understanding in the market, more certainty, more standardization. All of that actually reduces the perceived risk for everyone involved. It's likely a rising tide lifts all boats scenario.
And something you mentioned earlier really stuck with me. Their core mission is not selling the Bitcoin. They're fundamentally long-term holders.
That's a critical point. These Bitcoin treasury companies are explicitly mission-focused on not selling Bitcoin. Their actions effectively take Bitcoin off the spot market and lock it away for the long haul. It perfectly embodies that HODL ethos, but at an institutional scale. And frankly, given Bitcoin's historical long-term exponential trend, selling it has generally been, statistically speaking, taking bad odds. The market just keeps grinding higher over time.
So looking beyond the companies themselves, how are the actual markets evolving to support this? We're moving beyond just listing on the NYSE or NASDAQ, right?
Yes, the infrastructure is evolving too. There's this really interesting concept of pricing these treasury company stocks directly in Bitcoin using layer 2 technologies, things built on top of Bitcoin like Blockstream's liquid sidechain. Think about the advantages. You could have 247 markets denominated in Bitcoin, accessible anywhere in the world, any time zone. It removes the friction, the cost of constantly converting between fiat and crypto. You could have tokenized shares updating their value in real time on platforms like SideSwap.
And if these shares are tokenized, what does that enable? What new things can investors do within this Bitcoin ecosystem?
Well, once you have tokenized treasury stocks, you can potentially use them as collateral to borrow Bitcoin. This opens up whole new avenues for things like the Bitcoin basis trade, playing the difference between spot and futures prices, but using these tokenized equities. It allows for sophisticated, calculated leverage strategies, all happening natively within the Bitcoin financial system.
Okay, let's shift gears slightly and address some of those lingering concerns people often raise about Bitcoin itself. Things like mining pool centralization or node counts. Do those issues pose a real threat to this whole treasury model?
It's good to connect it back to the base layer. Look, Despite those fears you hear sometimes, the Bitcoin network itself is arguably continuing to decentralize globally.
Yeah.
We saw the big mining migration out of China, and now we're seeing diversification potentially away from the U.S. too. And you have to remember, it's not just miners. Economic actors, political forces, the tech providers, they all have influence. The network today is probably the most robust it's ever been.
Hmm.
That skepticism you mentioned earlier, it's actually like a healthy immune response. It forces the network to adapt and become stronger.
And then there are the unavoidable real-world headaches, right? Dealing with different legal names, KYC rules, complex company structures across borders. The traditional financial system isn't exactly built for digital speed yet. How does Bitcoin fit into that messy reality?
Yeah, it's definitely a dynamic space. Digital assets are still evolving within that older system. The beauty of Bitcoin, though, is its flexibility. You can interact with it peer-to-peer, company-to-company, or through regulated banks. Different countries are finding their own paths, balancing liberty, privacy, and regulation in different ways. But ultimately, Bitcoin as this global decentralized network, especially with layer 2s like Lightning speeding things up, still offers the strongest properties of sovereign resistance and sound money. We have to accept some imperfections along the way. It's incremental progress toward, hopefully, a better financial system. Bitcoin's proving pretty adaptable through it all.
Okay, so if we boil down our deep dive today, these Bitcoin treasury companies aren't just passively holding Bitcoin, they're actively driving a digital transformation. They're fundamentally using corporate finance and new instruments to reshape capital markets as we know them. It's really quite something to watch.
Absolutely. And maybe here's a final thought to leave you with. Think about how this ongoing digital transformation of the capital markets, led by these pioneers, isn't just creating new ways to invest. It's forcing us to fundamentally question and redefine what we mean by value, by collateral, by risk, across all of traditional finance. That profound shift, that rethinking, that's definitely something you'll want to keep a close eye on in the coming years.